All right, good morning, good Monday afternoon, everybody. My name is Seth Golden. This is Finom Group's weekly video. We did not have a weekend research report this past weekend, but we did put out a free publication titled The 2022 Investing Landscape and What May Lay Ahead for Investors. Now, of course, none of us can predict the future, and all the data, all the due diligence, all the research in the world won't predict the future, but most everything involved in investing, what the savvy investor tries to do is, of course, just like a card counter in Vegas, is stack the deck in your favor. As much information, relevant information, right? Because we don't want noise, we want relevant information that you can aggregate throughout the course of the week, throughout the course of the quarter. By and large, will do the savvy investor a great service throughout their investing career. So with this in mind, this weekend's basically publication that went out free to the public, we talked about where we stand in the market. You know, what's going on. We had a terrible end to the Q3 period. We pretty much finished at the lows of the Q3, the low of September. We made lower lows on the year. The initial low from June was taken out, and seemingly taken out with a vengeance. It's not just the equity market that has fallen prey to a lot of selling pressure, but the bond market. This is the worst year in the post-World War II era, I believe, for the traditional 60-40 equity bond portfolio. These bear markets, be them in the equity landscape or the bond market, are pretty treacherous. A lot of folks are throwing in the towel, as they say, and still waiting on some kind of capitulatory signal or email from the bond market or the S&P 500 saying, hey, by the way, you can come in now. The waters are calm. Of course, you're not going to get such a thing. As an investor, you got to use two of the most important variables to your advantage. One is cash, and the other being time. We've talked about these concepts many a time in the past, but when the markets are under such persistent pressure, here going into the 10th month of the year and seemingly making nothing but lower lows as the year progresses, we can often lose sight of those guiding principles of investing. One of them being bull markets are built on the back of bear markets. And that's what this chart here basically represents. This comes from eToro, the team at eToro, and this S&P 500 bear markets are in the light shaded color under the 0% line. Bull markets are above the zero line, obviously. And what you'll see most glaringly is that bear markets are rather shallow compared to bull markets. 21% decline, 1956 gave way to a substantial 86% return. 28% decline in 1961 gave way to an 80% return. Fast forward to the 1980s, we had a 27% decline in 1980, gave way to a 229% return until 1987's 34% decline led to a 582% return up to the dot-com bubble. But even that gave way to 101% return. Great financial crisis gave way to a 401% return. And then, of course, for newer investors, you recall that during the COVID crash, we had a 34% bear market correction that had given way to a 113% bull market return on capital. So bear markets should be perceived based on what you can get after the bear market is over, should be perceived as a good opportunity to further allocate capital. Most of investing, and you've heard me say this time and time again, if it was about your IQ, Well, then let's just say everybody would be reading the same books, taking the same financial market courses, and achieving the same results. But we're human beings. A lot of what guides us is emotions, gut instincts, and things of that nature. It's no different for investors. And so what you're often trying to control is your emotional quotient, not your IQ, but your EQ. It doesn't take a genius to do well in the market over time, especially nowadays when you have structured products that give you broad diversity, not diversity. Oh gosh, what's the word? I'm drawing a blank. Somebody in the chat box. Diversified portfolio. Yeah. I mean, you get ETFs nowadays, index ETFs, sector ETFs, style factor ETFs. All these different products make it easier to invest. Why? Because you don't have to be a stock picker. You don't have to do all of that quarterly transcript breakdowns, setting up your columns in a spreadsheet for revenues, gross profit margins, earnings per share, balance sheet performance, share buybacks, number of shares still outstanding. You don't have to do all of that with structured products, ETFs. All you have to do is stay in the market. That's why it's less about your intelligence quotient and more about your emotional quotient. You're trying to maintain an equilibrium across your emotions so that you're not panic selling when things don't go your way. You're staying in the market and benefiting from compounding returns over time. All right, let's move on. We found that a lot of our quantitative studies throughout the course of this year just haven't delivered on those higher probabilities. One of the most glaring ones that had never in the history of the S&P 500, which goes back to 1957, it's called the 50% retracement rule. Rule being used loosely as a term. But essentially, off of a bear market low, once you've retraced 50% of the decline since 1957, the market has never made a lower low until 2022, obviously, because we did a full 50%. Heck, we got to, I think, a 61.8% retracement off the low, and yet we still found lower lows. First time in history. Right? We know when it comes to data like that, when we're looking at historical studies and quantitative data, even seasonal data, sentiment data, we want to lean into the higher probabilities. Well, the probability that we would make a lower low was 0% based on history. There was 100% probability that we'd go on into a new bull market, and it didn't happen. It's one of the reasons why they say, history often repeats, but it's not the gospel. And one of the outliers that we aim to dissect and understand or define here in what made that 50% finally break its historic streak? It's got to be the Fed, right? I mean, it's the one major outlier in this cycle. We have a Fed producing, enacting accelerated rate hikes. That's the chart that you see before you here. Now, we know that in a typical rate hike regime, we can go back to the 1990s, go even since rate hike regime that started, I think, in 2004 or 2005, right? We didn't see this kind of disruption in the domestic equity markets, the bond markets, let alone global markets. We raised rates from 2004 basically to the 2007, but those were normal rate hikes, 25 basis points here, 25 there, no harm, no foul. The market continued to trend higher. That's not what's taking place here today in 2022. We've had 3 consecutive FOMC meetings with 75 basis point hikes. The one before that was a 50 basis point hike. We may have another 75 basis point hike ahead of us depending on how the September consumer price index looks. But what the chart shows you is that the worst S&P 500 returns over a 24-month period after the first Fed rate hike are accelerated rate hikes. The bottom trend line here is the S&P 500 during an accelerated rate hike cycle. All the others tend to trend higher over time. Gradual cycles for rate hikes and non-cyclical rate hike cycles. But the worst one is this one at the bottom, accelerated cycles, i.e. 1967, 1973, 1980, 1987, 1994, 1999, and 2004. They're not perfect. There's not a lot of samples there either. I think I just ran off a number of maybe 6 or 7 dates there, not including today's. But the pattern is holding. As of right now, we're 10 months into an accelerated rate cycle. And what it essentially is outlining is that the market has to adjust quicker. The market is adjusting quicker to higher rates, which is putting pressure on the whole valuation of the S&P 500 earnings. The equity risk premium is pressured. So until markets believe that we've hit the equilibrium in the effective Fed funds rate, or that the Fed has tackled inflation and we're on the verge of a disinflationary cycle, which is why the consumer price index for September is so important when it's delivered on October 13th. Mark your calendars, folks. The market can possibly start to price in a disinflationary cycle, a Fed that will have achieved its goal of tackling inflation and potentially pausing at the end of this year so far as further rate hikes are concerned. All of this is debatable. None of this is a forecast. It remains to be determined by the upcoming inflationary data, consumer price index, producer price index, and the PCE, the Fed's core gauge of inflation. For now, accelerated rate hike regime, a problem. Market has to price a different type of valuation. We came into this week trading at some 15.5 times forward S&P 500 earnings, which, by the way, from a valuation standpoint, is below the 5-year PE ratio and below the 10-year PE ratio. When folks talk about, well, this isn't priced in, that's not priced in, what the heck is priced in now? Because we're basically pricing in a certain degree of a recession and a great degree of these rate hikes. It happens far too often. What's not priced in? People are very quick to tell you what's not priced in. A recession's not priced in. Balance sheet and rate hikes aren't priced in, meaning the Fed, quantitative tightening and additional rate hikes aren't priced in. Weaker earnings are not priced in. Profit margin contraction is not priced in. Stagflation's not priced in. The dollar parity is not priced in. Midterm elections aren't priced in. Everyone seems to know what's not priced into, well, now a 24% S&P 500 peak to trough decline. But when you ask people what is priced in, you get nothing but these crickets. It's not fun to determine what is priced in, because then there's nothing to fear. But when you consider what's not priced in, it leaves doubt. It leaves room for fear to enter into the picture. So let's look at where we are today from a historical context. The table that you see here from Charlie Bolello, he recognizes the worst S&P 500 performances through the first 187 trading days of the calendar year. The S&P 500's return in 2022 ranks as the 4th worst performance through 187 trading days since 1928. The only ones that were worse, 1974, 1931, 2002, At the 187-day mark, they were all down more than 23%. 1974, from that day, from at the, we'll start 188th day of the trading year. It gained 3.2% into the end of the year. So it only finished with a 29.7% decline. 1931 got a lot worse. 2002 gained 6% into the end of the year. So in the past, down 23% or greater. Twice it's been up. One time it got a lot worse. You look at some of these other worst performances up to the 187-day mark. 18% here in 2001. You had a rally into the end of the year. That was a recession year. Still had a nice rally into the end of the year. You only finished the year down 13%. 1937, ouch. 1962, which a lot of people understand there's a strong correlation with the price pattern in 2022 compared to 1962. Midterm year, a decennial year. Ring a bell? That's what 2022 is. Gained 12.4% into the end of the year. And you'll get a lot of folks that will say, what was the Fed doing then? What was inflation then? What was housing then? Right? Again, my pushback would be, what do you think the market was doing up to that point? Markets are a forward discounting mechanism. It's pricing in higher rates. It's pricing in a declining housing market. It's pricing in weaker manufacturing, so on and so forth. Instead of worrying about what the Fed was doing, you should be worrying about what the Fed is going to be doing in the future based on that inflationary stimulus, if you will. And, regarding these dates, something else that we often talk about, and, quantitatively speaking, that failed, right? We've talked about this chart time and time again. The Q2 period, S&P 500 lost 15%. These are all the times that it lost 15% in a single quarter. These are all the times that the S&P 500 lost 20% over a 2-quarter period. The only unique standout for the next quarter's return was in 2008. It's the only time the market was down after a 1-quarter drop of 15% and a 2-quarter drop of 20% plus. Until 2022, because we were down the next quarter in 2022 also. So we had a 9% gain after the June lows, but it got wiped out. And we finished down for the Q3 period. The good news, 20% decline or 15% 1-quarter decline, 2 quarters later, right? So the next half, the market was positive every single time. That brings us to Q4, folks. So there's a 100% historic probability that the market would be up 2 quarters later. If we're going to keep that 100% streak, we have to be higher than 35.85, which was the closing price on September 30th in the S&P 500 by the end of the year. We have to be higher than 35.85. What do you think? Do you think we're going to be higher or lower? That's all that really matters. I hear a lot about, well, what if this is going to be, another .com situation? We're down 3 years in a row. First and foremost, going back to 1928, the S&P 500 is up some 75% of all years. And more often than not, highlighted by this pyramid of dates, the market is up 10 to 20%. On any given year, the higher probable return is between 10 and 20%. And so far as what if this is .com, You can worry about these things till you're blue in the face. In fact, if you are worried about them, more than likely, this is what you're always worried about. You got to get out of this mindset of what if this is like, 1970s? What if this is like the 1940s during the World War II period? What if this is like .com period? You're talking about the least probable outcomes. You're talking about the glass being half empty all the time. You're not talking about a healthy emotional quotient for a savvy investor. That is not you if you are constantly worried about multiple down years in the market. Instead, if that's the case, you should be saying to yourself, that's the definition of a generational buying opportunity. How can I say that? This chart right here of the S&P 500 returns. Below zero are negative returns, above are positive returns. 2000, 2001, 2002. That was the last time we had a multi-year downturn. Negative returns each year. Before that, you had to go all the way back to 1973 and 74. 2 down years. And by the way, these down years were completely wiped out in the following 2 years. Completely. Before the 1970s, you want a multi-year down year for the S&P 500. Like I said, you have to go back 1939, 1940, 1941. It is very rare to generate a multi-year downturn for markets. You're looking you're looking through the lens of a disturbed investor emotional quotient. If you are investing, it should be because you're optimistic about future returns. When you're focused on what ifs and the fear-mongering headlines that are out there that can prove so pervasive, there's little positive returns that are likely to be produced in your portfolio. That was an alliteration, like I can't repeat, by the way. So you got to stay positive, folks. Here's another consideration, right? What about the Fed? I mean, I can show you so many ways why it is extremely difficult to have consecutive down years in the S&P 500. I mean, besides this bar chart basically displaying it for you in color. People say, well, what if we go into an earnings recession? What do you think happened in 2015? We had an earnings recession. Here you go. 0.73% negative S&P 500 return. Now, you actually got a positive return if you were invested in an index ETF. Because you got the dividend for the year of about 1.5%. So you actually still made money. But that was an earnings recession year. We've had lots of recession years for earnings. And yet the S&P 500 still delivered a positive return. Here are the earnings for the S&P 500 going all the way back to 1960. So now remember, 73 and 74, 73, 74 are down years, 75 and 76 are up years. Let's go look at the earnings for those years. 73, here were the earnings. They grew from 72. So you had year-over-year earnings growth, but a negative return. 74, you had more earnings growth, but a negative return. Look at 75, earnings went down, but we had a positive return. 76, earnings went up again. We still had a positive return. It's not always earnings that drives the market. In fact, there's a greater correlation to what the Fed is doing, what central banks are doing, than there are earnings. Key consideration here is that investors are generally investing capital because they know over time the earnings will grow. $1.98 in 1960, here you are to 2021, and you're at $206 a share in earnings. They're gonna grow over time. Earnings growth is intrinsic to investing capital. investors are willing to wait for those earnings. It doesn't have to happen on any given year. They know it will happen over the course of multiple years. Here's another. Let's go to the 80s. Let's see. 1981 was a down year. 1982, 1983, 4, 5, 6, 7, 8, 9. Number of years where the S&P 500 did nothing but go higher. So let's look at the earnings from 1982 to 1989. Were they climbing? Here's 1982. Here's 1981. Earnings were actually growing in 1981. Remember, the S&P 500 fell in 1981. Here's 1982. Earnings are down. The market was up. Did earnings get better in 1983? They surely did not. They kept going down. The market kept going up. Finally, earnings grew in 1984. Market kept going higher. 1985, earnings fell year over year. Market kept going higher. 1986, earnings continued to fall. The market kept going higher. 1987, we all know the situation there. We had a big intra-year drawdown, but the market was still higher for the year ever so slightly with a 2% return. But earnings, 1604, market was higher. 88, market, earnings higher in 1989 as well. But there were a number of years here in the middle part of the 1980s, and yet S&P 500 still went higher. That's why I say earnings aren't everything, because investing capital, earnings growth over time is intrinsic to that exercise. Investors are willing to wait. It's not the key driving force for any given year. What tends to be is what the federal bank, what the Federal Reserve is doing. Here from 1971 to 2022, we can look at easing Fed or a tightening Fed. We can look at accelerating profits or decelerating profits. Accelerating profits with an easing Fed, 3.5% average return for a quarter. This is each quarter when the Fed is easing and you have accelerating profits. There's only a 26% probability of a loss. Profits are decelerating, but the Fed is easing. You have a little bit lesser average return and a 29% probability of a loss. In both of these cases, you have a 70% or better probability of a profit. What about when the Fed is tightening? Tightening, accelerating profits, average return 3.9%. That's the highest actually. Only an 18% probability of a loss. But when profits are decelerating, why the Fed is tightening, which is where we are today. That's where we are today. We have decelerating profits. Are they growing? Yes. But they're not growing as fast as they were last year. The probability of a loss grows to 43%. That's the quadrant we're in right now, folks. It all lines up. All right, this is just another example of years where this chart, again, basically mirrors, what we see here. What I did was basically extrapolate the years where the S&P 500 had declining EPS. These are all the years from this table where you had declining EPS, but the S&P 500 was either up or down. Here we had 9 occasions, declining EPS, but the S&P 500 was up. Here we have 4 times that the S&P 500 was down with earnings being down. And again, 2015 is debatable because an index ETF, you got a positive full year return. So 9 times was the S&P 500 higher for the year, even though EPS was down. So the point on highlighting this, reiterating it, is that you hear a lot of the punditry, you hear a lot of analysts, well, what if earnings are flat to negative in 2023? It doesn't mean the S&P 500 will be down. Historically, there's not a direct correlation there. There's a greater probability the market will be higher, not lower. Well, the estimates are coming down, changing consensus EPS projections and market returns. Change in annual EPS estimates over that year, going back to 1985. 1985, you had estimates coming down 16%. Look at the S&P 500's performance. In fact, you got a lot of estimates. That's usually the case. Most of the time, estimates are coming down. Doesn't matter. S&P 500 goes up. I've showed you realized earnings down year over year. I've shown you EPS estimates coming down on the year. And in both cases, more often than not, you get a positive return out of the S&P 500. Usually the problem lies somewhere in this chart. And that's what's happening this year. We're getting a rate of change in the valuation because we have an accelerated change in interest rates. It's a shock to value. Or I'm sorry, it's a shock to valuations. Equity markets are playing catch down to a lower valuation in a higher interest rate environment. The headwinds today for valuation, or for this year, when it comes to valuation, generally don't prove sticky, especially if there is some kind of change in monetary policy come the next year, assuming we're tackling inflation and the economy's going at a slower pace, which is all what the Fed wants to see. Again, here's CPI. We talked about CPI. What about combining the current inflation regime with negative year-over-year earnings declining? Kind of a double whammy of headwinds for positive S&P 500 returns, you might assume. Years when CPI is above 5%, like today, which is rare. I mean, today, here back in the 1940s, here in the 1970s and 1980s, it's rare. So years when CPI is above 5% and falling, right? So we've had a couple months here of CPI declining, as is the case presently, with EPS also falling year over year, and no recession or the recession is ending. Like, these criterion are very rare, but they're happening this year, just like they happened in the 1970s, in 1970, in 1975, 1982, and 1991. The combination of elevated but falling CPI with earnings deceleration and or outright falling are rare, but all years found the S&P 500 delivering a positive return. This is the most accurate description of where we are should we stay here for 2023. If we closed the calendar year today and we called it 2023, the start of 2023, that's where we would be, given the criterion stated in this bullet point. That's why I say today's devaluation, today's derating is the headwind for this year. But if you think you're going to get a repeat performance next year, then you have to believe inflation is going to get worse. The US dollar index is going to get worse. The Fed is going to continue to hike rates at an accelerated pace, so on and so forth. History teaches us, though, that is very unlikely. So again, we're talking about how do you get the S&P 500 to fall in consecutive years, as would need to be the case for 2023. And it's simply a rarity using all of the criterion we have today. So here today, what should you be doing with your portfolio? In my opinion, start working on that compounding gains by allocating capital into this deeper valuation. We're heading into the midterm elections, November 2nd, I believe. Midterm seasonality, folks. November, election day, November through April of the next year. Don't forget, folks, The market has never delivered a negative return going back to 1942 of a midterm election year. November through April of the following year, market has never delivered a negative return. The average return is 17%. You don't see any negative signs next to any of these dates. Again, what should you be doing with your portfolio? Mark the date. So November election day, or probably the day before, you might want to think about buying some stocks. If not, index ETFs. With that being said, I'm Seth Golden. Thank you for tuning into this week's, weekly update and broader market outlook.